Today's show is brought to you by our sponsors at Betterment Advisor Solutions. If you happen to be thinking, there's got to be a better way to grow my RIA, you're not alone.
With Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most, your clients. From improved service that makes asset transition smoother to fast, paper-free onboarding that delights clients on day one.
We've built a digital-first platform designed to streamline your operations and make life easier. Now, if you're thinking, wow, they take the paper out of paperwork, you'd be right. Grow your RIA your way with Betterment Advisor Solutions.
Learn more at betterment.com/advisors. Investing involves risk, performance not guaranteed.
Welcome to Animal Spirits with Michael and Ben. I am on the airplane this morning, taking off. Got CNBC on the seat in front of me. Boom.
On mute?
Yeah, I was working.
I'm kidding.
Sam, and big headline. OpenAI. Investing in AMD. I was about to make a joke. I couldn't think of anything. So OpenAI doing some sort of deal with AMD. Who cares what it is? Sam Altman tweeted, excited to partner with AMD to use their chips to serve our users. This is all incremental to our work with NVIDIA, and we plan to increase our NVIDIA purchases over time. The world needs much more compute. So AMD, NVIDIA, you're still good. Stock is up 25% of the announcement. I don't know what's up right now. $280 billion company just adding $50 billion, whatever the number is.
Everyone
Boom,
in the boat.
like that. Let's go. It's bubble time. Let's do it.
The funny thing about this whole thing is just that it feels like there's not. I don't know if I guess you'd call it an oligopoly. Like it feels like they have everything cornered, but they're all doing it together and being like, "Hey, we're inclusive. You come too. You can take a little table scraps, sure. Yeah, you want some too? Yeah, you too. Let's do it."
Intel. Where's Micron? They feel left out. Hey, so last week after our show, I thought to myself, you know what? We're gonna do a hyperscaler free episode. It's enough.
Come on,
it's enough already.
It's impossible. So you have this in here. I saw it too. I had CNBC on. I have my three screens in my office, and I have CNBC on one. And Paul Tudor Jones is on this morning. So I turned it on. And credit to Andy Ross Sorkin because Paul Tudor Jones said, listen, it feels like 99. And he said, I think he essentially said this is potentially more explosive than 1999. He was saying listen, we're in for a blow off top here. And Andrew Ross Sorkin pulled up some old quotes of his and last time you were here, you were talking about the end of the world and you were talking about recessions and Paul Tudor Jones kind of smiled and he goes, yeah, you know what, so I credited him for saying this because he's been wrong like every hedge fund person, but he said, listen,
hang on. He's been wrong like everybody. You don't have to single out hedge fund. Who's been right?
Well, true. But so it was kind of funny. And he said, listen, I've been wrong a lot, okay? Everyone's wrong. And he said, but my whole investing philosophy boils down to the 200-day moving average.
Yeah,
he's been the 200-day moving average.
Quote, wrong. I'm sure he's made gazillions of dollars. So he's not one of those pontificators that just bloviates and doesn't actually invest.
Yeah, I think he's more of a quantitative investor that has qualitative discussions sometimes. And he said, I use the 200-day moving average. When it's above the 200-day, good things happen. When it's below the 200-day, bad things can happen. And last time I was here was below the 200-day. So I was thinking bad things are going to happen.
Fair enough.
And then it did. So I thought it was actually a pretty good back and forth. But so is this the point that we've reached is the next line of predictions is blow off top?
All right. So I mentioned that I genuinely thought we were going to do an AI-free episode. It's just tiresome at this point. We've got 55 pages in the doc, so apologies in advance. Is this, I'm thinking about this, this is the biggest market story of the last decade, right? There's been pockets of time where all we're talking about is inflation, all we're talking about is interest rates.
No, COVID was
hang on. Wait, let me finish. All we're talking about is COVID, but that was within the context of a crisis. So absent crisis moments over the last 15 years, this is the single biggest market story, and there's nothing even close.
This is one of the biggest market stories that we will ever have.
Correct. This is going in the textbooks. All right. So
Didn't
anyway,
Michael Semblis say this is the stock market bet of the century?
Yeah.
This is not like the biggest story of a decade. This is potentially the biggest story that it's crazy to say, but it seems true.
All right. Here's where I'm at. It feels like everybody is aligned. Okay. We are entering the next phase of a blow off top. Maybe it lasts a year, maybe it lasts 2 years. So everyone's bullish in the short term, but everybody knows it's going to end badly. There's no way it's going to play out like that. There's no way, right?
No, but that is the perfect hedge to make a prediction. The stock market is going to go up, but then it's going to fall. How can you be wrong in that scenerio? You can't. Because if it falls, you go, I guess I was just a little early.
Yeah, I was early.
Too.
On Monday, a week ago, I sent you and Josh an image that I created from ChatGPT where it's everybody watching a bubble inflate. And it really feels like this is the moment, right? Like How
come every person in this AI generated picture is exactly the same? Like the women have the same face as the men.
I don't know. They all have the same. Although if you look back a few rows, it's a weird image. But Derek Thompson this week wrote an article. This is how the AI bubble will pop. He had an interview with Paul Kudrowski. And it's not just Derek. I mean, it's quite literally everybody.
I made the point this morning on Twitter. There is a bubble in financial news stories using pictures of bubbles. Look at all the picture. Every picture now has a picture of a bubble in it.
Yeah.
That's how you have to start the article. I just think so. Chart Kid Matt did this thing where he showed that the stock market bottoms 9 months on average before earnings do in a bear market, right? So the stock market is forward-looking in a bear market. So I said, okay, that's great. What about the top? Can the stock market call the peak in earnings before it happens? And we looked at it, and it cannot. The stock market, look at this chart, the very first one here. The stock market and earnings basically fall together. It's within like a few days. So the stock market is forward-looking at the bottom.
That makes sense, like from a human behavior point of view, because nobody wants to leave the party early.
Yes, but so the thing is, no one is going to be able to predict this coming fall. Not even the stock market. It's going to happen like when it happens, and I agree with you. It seems almost too easy to say, well, this is a bubble and it's going to pop like all the other ones. There's no way. The market is never that easy.
I mean, maybe, but it seems hard to believe.
Yes.
Did you make this GIF of Derrick Henry standing next to Mark Ingram?
Oh yeah, you did a meme, so I had to do it. It's one of my favorite meme templates.
That's good.
It just seems like AI is subsuming everything else with the economy and with the stock market. That you keep hearing about the slowing labor market, but guess what? The growth for this coming quarter is still projected to be almost 4%. So yes, people keep worrying about the labor market slowing. The stock market doesn't care. The economy doesn't care. When does it matter?
Stalwart Mr. Weisenthal tweeted, according to Challenger, the pace of hiring has fallen off a cliff. Weakest September for job creation since 2011. And it is a push and pull, as the pundits say. I don't know, man. It'll matter when it matters. I have nothing I have no insight here. I think that's the thing. Like, nobody does. Let's just be honest. We're all making this up. We're all guessing the best we can.
Yeah. That's one of the things that makes these kind of manias fun, because no one has a clue when it'll end.
Chart from JP Morgan estimates the 5 major AI hyperscalers will spend a combined $1.2 trillion from 25 through 27. How could you be bearish? I mean, you could say this is stupid and this will end badly. Sure. I think everyone's saying that. But Martin Shkreli is shorting, I believe, some of the quantum computing stocks, which by all accounts, there's nothing there.
What, are we taking investment advice from this guy now?
Well, just hear me out. The Rigetti CEO was...
They need to change their name. It sounds like a pasta company.
I got to be honest. I have no... Is Rigetti quantum computing? I genuinely don't know. Sorry.
Yeah, I think so. But they need to change their name.
So he said, he was talking to Yahoo Finance, and he said, because of the hype that is going on in the quantum computing space and some erroneous statements are being made, including by people in our industry, we have to tamp down some expectations. I have to tell investors that it's still not the time to talk about sales. Not the time to talk about sales. There's no revenue and sales growth because we are still very much in the technology development mode. So it's essentially an experiment. We have to get the technology perfected before we can start seeing real material difference in sales. And guess what? It doesn't matter. Stock's going straight up. So Shkreli is short. Obviously, a lot of people are making money on the long side. I think here's where I'm at with like shorts and longs in this in one corner of the mania that we're experiencing. Nobody comes out alive. Shorts are going to get taken out just because that's just how the market gods work. They're not going to let you make money. You're going to get margin called. It's just not going to be enough. And then it'll fall 90%.
Well, did you read the Jerry Newman piece at Colossus a few weeks ago that basically said no one's going to make money in the AI bubble? Right? I agree with like trying to sort through the winners and losers at this point beyond the hyperscalers.
I think Citadel will make money.
Right. Yes. The timing and the magnitude, that gets you every time. Listen, it's a human experiment though that we're running here. Right? That's what makes the stock market so endlessly fascinating to me. Is that it's like a laboratory for human emotions. And how far can we push them? And how far can they really go? We're gonna find out.
Yeah. So JP Morgan, and this is from JP Morgan via Bridgewater. US real GDP growth contribution from tech CapEx. So it's showing that versus contribution from the rest of the economy. And somebody tweeted, this is alarming. Almost 40% of the US real GDP growth last quarter was driven by tech CapEx. Aggregate CapEx can't keep climbing like this in the absence of real profits derived from AI investments. And somebody replied, this is a surface level take. Most AI CapEx is spending against current demand with revenue coming in immediately. Let's dig a little deeper. Both fair points, but the unknown of where this goes is you're right, Ben. That's what makes it fun.
Right. The demand is coming from Oracle, which is coming from OpenAI, which is coming from NVIDIA, which is coming from Oracle, which is coming from OpenAI, which is coming from NVIDIA.
Didn't we say at the end of August that September was historically one of the weakest months of the year?
I tell you what, I don't know how the seasonality stuff works. Like what's a historically good month or bad month? You tell me.
Well, you wouldn't. I'll tell you. September historically is not great. We 3.5% in 2025, fourth best September since the turn of the century.
Okay,
not bad.
Tell you what, seasonality doesn't do much for me.
Yeah, I can take it.
I'm not gonna lie.
All right, Todd Stone has a chart showing a table. The annual contribution for the S&P of the 10 largest stocks during positive years. And 2021, 2020.
Wow, this is very surprising. I don't remember anyone talking about this in
2023 and 2025 are all.
It is funny that
top 6.
99 and 2007, which are the tops, but I don't remember anyone talking about this in 2007. That it was 80% of the total almost.
Well, this is before you had a podcast.
True. But obviously you look at these and you go 99 was a top, 2007 was a top, 2021 was a top, and then there's other years you can look at and say, well, those ones didn't matter.
All right, here's a chart that was making the rounds this weekend. The forward PE of the S&P, cap weighted versus equal weight. And needless to say, maybe not needless to say, they generally track each other pretty closely. There was a huge disconnect during the dot-com bubble, and there was a pretty big disconnect today.
Yeah, not nearly as wide as the dot-com bubble, though, obviously. Okay. So short S&P, long equal weight.
Sure, maybe. But I feel like the people that are posting this chart have literally been saying the same thing since 2015.
Yeah, they were pounding the table on CAPE ratio back then. Okay, awesome new chart from JP Morgan. They had their new guide to the markets. I think I get an email every time that a new one comes in. And this chart has never been here before. They look at the top 10 names going back to 1985 every 10 years. Pretty sure JP Morgan stole this idea from me because I did it before, not to brag. I'm kidding. But they show which ones have stayed over time. And you can see there's a total turnover from 85. There was a few of them that hung on for a little bit, right? IBM hung on there for a little bit. GE hung on. Exxon. Walmart. And there's no names that were in the top 10 in 95 that are still there today. So there's been a ton of turnover between now and then. And Microsoft is the only one that was there in 2005. So here's the thing, though. I feel like since 2017-ish, when these tech companies really started to take off and their dominance was becoming more well known, the one thing people would say is, "Listen, just wait till the government steps in and breaks these companies up." I think we've learned the government is literally they can't do that, or they don't want to, or it's never going to happen. These companies are too big and powerful for the government ever to step in and break them up. And I think that at one time seemed like a real risk. I just can't imagine that happening today. Can you?
Breaking
Can you see
these
that?
up? No.
Yeah, you've got to sell off, YouTube. You've got to sell off cloud services. They're too big and powerful. So it's going to be their hubris, or the next in 2035, it's going to be a bunch of robotics companies or something else that comes up to take their place. But it's not going to be because the government steps in to take away their power. Obviously,
I don't
their
know
power is
about
just
that.
growing.
I don't think it's a foregone conclusion that there's going to be a lot of turnover just because there has historically.
Okay, I'm going with history here. You don't think that there's going to be some robotics companies that are going to step in and new AI companies, and that's the way that this stuff works.
Historically,
some of these companies are going to trip and fall. That's okay. Sure.
Listen,
Maybe this time really is different.
I'm not pounding the table, but I would say even money. How long are we talking about? Are we talking about 2035?
I think that the historical turnover rate is something like 30 to 40%. So 3 or 4 names. Right?
I would say the historical
5 to 10
turnover rate
years
is going to be way less today, way less in the future than it was historically. I would feel pretty comfortable saying that.
I think we could. So we'll talk about this in 2035, in year 17 of our podcast. But I still think that 2 or 3 of these names are going to trip and fall, and something else is going to come, or something else is going to come and take their place.
All right. Well, 2 out of 10 is not. I mean, that's nothing.
2 to 3. That's historically 30% or so is average.
All right. Great stuff from Rob Anderson. NASDAQ 100 has not seen a 3% correction for 115 days. It's the 7th longest streak going back to 1971.
So since April, essentially, then.
For all the bubble talk, I thought this was interesting. U.S. equity gains trailed the rest of the world, this from Bloomberg, by the most since 2009. How do you explain this?
There's a lot of really weird stuff going. I keep saying, if this is a bubble, it's the weirdest one ever. Gold hits new highs every day, it seems like. Bitcoin hit new highs. It's just everything.
International stocks, you saw Japan is ripping this morning. Yuri and Timber tweeted, strong technicals are confirming the bullish fundamentals. Finally, non-U.S. equities have a reason to mean revert after being left dead for over a decade. He's got another chart showing the payout ratio and how these companies are taking a page out of our book. It's global, man. It's not just us.
If you're not making money this year, you should just retire for being an investor. Hand the keys over, turn them in, put it all in index funds or something else. If you can't make money this year, you're never going to make money.
That's true. All right, what's the CMO that we got, Ben?
All right. Let me hear you think here. It seems like other famous bubbles are accompanied by an anecdote of someone completely ignorant of the investment making an investment. Darwin with railroads, Joe Kennedy allegedly said, when the shoe shiner asked about the market, he threw in the towel. What feels different about the AI is that there really doesn't seem to be a lot of stories about people with zero idea about AI or the market just running and throwing life savings at AI names. People investing in it are doing so in a fairly rational manner through indexing or, for the most part, ETFs. Thoughts?
Yeah, I reject this dramatically.
Dramatically. I think I agree with it I'm 75% of the way there. It doesn't feel like this is 99 where people are quitting their jobs to day trade or quitting their jobs because they're going to turn over houses, right? And I'm gonna buy and sell houses, and I'm gonna fix them up a little bit and resell them. Those are the kind of things that are happening in those bubbles. It doesn't feel like we have that kind of stuff happening today. The anecdotes of.
All right. So
I will give him that point.
Let me present the counterpoint. Hamptonism, at Hamptonism, tweeted, I'm convinced anyone with any level of education can turn $100K to $500,000 in 12 months. Buco Capital retweeted it and said, we're close at the top. It's okay to keep dancing, but recognize where we are. Here's another one. Oh, this is from Martin Shkreli. Let me share my screen for a sec. First of all, this is a fake. I guess it's from Sora, which we'll talk about in a sec.
Mm-hmm.
All right, here we go.
I have a dream that all overvalued stocks will collapse and the market will be efficient once again.
Not bad, right?
Okay, that's all right. So
okay. So wait, hold on. I'm not done.
Okay.
All right, here's another one. Somebody, I don't know if this is Reddit. It looks like Reddit. After 2 months of thinking, I decided to quit my job today. They show their portfolio. Feels good, but
so
I feel
this
like
happened. I was wrong.
TikTok investors tweeted, everyone is a genius in bull markets. So this person talks about their strategy and trading. We've got 19, this is from Bespoke. We've got 19 stocks up 400% since Liberation Day low. And let's see, all but 4 of them are money losing companies. Cypher Mining, I don't know, Kodiak Sciences, Oklo, we just talked about Tango Therapy, a bunch of other names I've never heard of. We've got, this is from Deutsche Bank.
I don't know. I've never heard of any of these companies before.
Okay.
I love how they have the P ratio and like 90% of them are negative.
Yeah.
Right? They don't have a profit. That means they don't have a profit.
So going to the retail thing that we've been talking about, how these people are just killing it. Sherwood had a chart showing the Goldman stock retail index is up like 19 straight days. I forget what the number is, but it's madness. All right, so Deutsche Bank has this wonderful chart showing the performance of the most shorted stocks going vertical and the stocks with the most net call volume going vertical. And let's just say that these are both retail names. You've got the Defiance company launching a bunch of 3X ETFs. Modest Proposal tweeted factor effectiveness, the recent 12 months comparison to long-term performance. We're looking at the best versus worst quintile. So I guess looks like this is long short. What's number 1? High 9 price month momentum, high 12-month price momentum, high R&D to sales, high beta, and the worst is all like value stocks. Mike Zaccardi tweeted, the last 6 months have been all about low quality. The junkier, the better. Augur Infinity has a chart which he's showing the S&P 500 performance since the lows versus the non-profitable tech stocks. Non-profitable tech is up 105% since the lows. The Rigetti stuff that I spoke about earlier. So Ben, it's happening. People are going absolutely bananas for stocks. So
when I was in my manager selection days, those portfolio managers would definitely have said, listen, this is a junk stock rally. We're not going to chase the junk. We're high quality, balance sheets, low debt.
It is.
Okay, so here's the other place where I think that there is I hate calling everything a bubble because at a certain point, you know how all the Gen Z kids, they say that everyone is a goat, hey, this person at my company, they're a goat. Like you can't call everyone a goat. Not everyone's the greatest of all time, okay? Stop using goat so much, young people. Like it's reserved for like 1 or 2 people in your life. That's it. So I don't want to call this a bubble, but we're at all-time highs and we've never been higher. There are so many rich people now. And you and I are I think you and I are in kind of an interesting way to view this because not only through our business, but because of all the people we hear from, that there's never been so many rich people as there are right now. And it's funny because the conversations that I'm having with really rich people in our day job, the biggest problem they have is, what do I do about these huge capital gains I'm sitting on? That's the problem people are trying to solve for. And that's obviously a bull market problem and phenomenon. But I just think that there's never been more rich people. And I think that explains
it's a big part of the story.
Much of what's going on.
Well, right? Let me ask you this. The B word, the bubble word. Stocks, these stocks that we've been Meta and Nvidia fell 70% in 2022. Amazon and Google got cut in half. I don't remember a lot of people saying, see, the bubble is over. The bubble just popped. My point is, what would have to happen for us to say, you see, it was a bubble? Because it's not these stocks falling 40% and getting back to where they were in 2023. That's proof of nothing. That's proof of, all right, yeah, these stocks were overvalued. A bubble bursting means Nvidia's got to go to $1 trillion.
It would mean
lower.
The S&P would have to fall 40% and the NASDAQ 100 would have to fall 50. I think that's okay, it was a bubble.
So if the NASDAQ doesn't fall 50, get out of here. The NASDAQ could fall 35%. It means nothing. It fell 35% in the first quarter, didn't it?
And in 2020.
And in 2022.
Okay. Yeah. That's fair. Yeah.
80,
The whole
I don't know. I don't know what the number is. It's 50% at a minimum, or don't say the word bubble.
I think that's a fair definition.
At a minimum.
If Handy, put your gambling hat on. What will the odds of a 50% crash be in the NASDAQ 100 in the next 24 months? 24 to 36 months. What kind of odds would you have to get?
If you said 24, what would make me bet on a 50% crash over the next 24 months? I don't know, man.
You need a really high plus odds.
Plus 700? How about this?
Oh, I would need way higher odds than that.
All right, for you to put, I don't know, 10 grand. 10 to 1?
At least.
Actually, you know what? If anyone's willing to give me 10 to 1 odds, I would take it. That's a good payout.
Okay.
If you extend it to like 48 months, then I would say 7 to 1. 50% is a lot. And now it could,
that's what I'm
obviously,
saying.
It could happen. Of course it could.
Mm-hmm. Yeah. But what is the level we're going from, to your point? And what does it bring you back to?
Well, that's the other part of it. It's like, listen, where's the S&P? Is it 60? Ooh, is it 60? What is it? 6,700. Okay.
Mm-hmm.
So if the S&P goes to 8,500 and then goes back down to 6,000, who cares?
Sam Rowe had a great point the other day on Twitter that the Dow bottomed at like 6,700 in the great financial crisis. Now it's at 46,000, almost 47,000. And now the S&P is at 6,700. Round numbers.
This is a good thing. It goes to the retail stuff that we're talking about, but you love to see this. The value of equities held by the bottom 50%. And this is all Robinhood, so credit to them. This started to go vertical in 2020. So in 2000, it was 175.
This was also the pandemic, though. This was the pandemic. People had disposable income for the first time. A lot of people for the first time in a long time.
But the bottom 50%, the value of equities had gone nowhere from 2000 to 2020. So 20 years. Not inflation adjusted, I don't think. And now it's 600 billion. Now there's a denominator thing in here. Like, I don't know how many people this is, but nevertheless, this is still a good thing.
No, the jump here was so high, you can't say that this is just, but here's the thing. To me, 9% inflation was worth this. We don't get this without 9% inflation.
All right, that's
was
debatable.
it worth it?
I don't. I have
no
to
way.
think more about that.
Because it was all the money we sent to people. That's why this happened.
Yeah, I don't know. That's a big.
I think that's a reasonable trade-off as far as I'm concerned. Let's add one more thing to your bubble thing. This is from the Wall Street Journal. Yield premiums, corporates over treasuries is at a 27-year low. The spread.
Wow.
And the quote from the article was, "It's kind of the old spreads are tight, but yields are all right." So yields are high, so people don't care. They're buying corporate bonds hand over fist.
So there's
not requiring much of a spread.
So same with junk too. So there was another journal article talking about this, and Howard Marks said, and this is definitely true. It just is. The worst loans are made at the best of times.
Yeah, that makes sense. Right. Okay. I feel like that, to me, they're starting to get a groundswell of inequality stuff. I feel like the inequality chatter is it's growing. So here's a question for you. So because I looked at the Atlanta Fed now, and again, it's like 4% for this quarter. They're not all seeing, all knowing, whatever. But let's say we get a slowing labor market, right? And it doesn't really impact the economy. People start losing their jobs, but the top 10% controls 50% of consumption. I think the top 40% controls 60 to 70% of consumption. AI makes businesses more efficient. Okay? So parts of the economy are slowing, but the economy or the labor market are slowing, but the economy still does fine. Mainly because of
you mean like what's happening literally right now?
Yes. Let's say this continues. Is your strategy to buy torches and pitchforks? Because look at this.
Stop. I don't want to go there.
Listen, I'm living in the world as it is, not as I would love it to be.
Hang on. This idea.
Look at this next chart.
Okay.
Look at this next chart. This is from Charter today. America's top 1% holds almost as much wealth as the bottom 90%. The bottom 90% holds 33% of wealth. The top 1% owns 31%. And it was
forget about the top. Hold on.
In the 1990s.
Forget about the top 1%. It's Elon and Larry Ellison and Bill Gates and Steve Ballmer and Jeff Bezos. Like, this idea that it's only the billionaires and everybody else is screwed I'm sorry, I reject that idea. Listen to what the companies are saying about their consumer. They have no reason to not tell the truth. I feel like we're beating this dead horse.
No,
Yes.
I agree. But listen, if you are boxed out of buying a house right now and you live in a very expensive city and inflation feels higher, and I don't know what percentage of the population, let's say 33% of the population, because 62% of people own stocks. The home ownership rate in this country is 65%. So let's say a third of people are boxed out, and some of them do that by choice. So let's say it's really 20% of people are boxed out of the stock market and the housing market. Who do you think they're going to blame for their plight?
Listen, I'm not denying
Rich people.
that there are people struggling. Obviously, there are, and I'm not insensitive to that. I just feel like we're spending too much time on that topic as a society. It's like we're only focusing. There's so much good happening in the world, and it's very easy to feel like there's just a lot of bad things happening because there are, and we're more aware of it. But there's a lot of good things happening. I was in the airport today at JFK, one of the busiest airports in the world, and guess what? It's not all billionaires in there.
But here's the thing. It's never been easier to look around you and see wealth extravagantly on social media and in news stories.
Yeah, well, I agree. Well, guess what? We don't need to contribute to that on this podcast.
All right. I told you, I'm living in the world as it is.
No, you're living on social media world as it is.
Because listen, AI is going to make wealth inequality. Wealth inequality is going to be supercharged in the next decade. You watch. Short of a nasty market crash.
Outside of social media, this is not a topic of conversation.
Wealth inequality? Ugh, I don't know, man. Going to be. You wait. This is going to be a big thing. In the coming decade, this is going to be a huge issue. You watch.
All right. You sound like you're rooting for it.
I'm not.
Dude, what do you mean? Wait, hold on. What do you mean it's going to be an issue? It is an issue. It is an issue. I'm not saying that it's not.
Okay.
It is an issue. But do we ever focus on the positives, or are we only going to focus on the negatives?
Hey, listen, you're right. I try to be a positive guy. I will listen. I think the fact that so many more people invested in the stock market is a huge positive.
It's so easy to focus on the negatives, and I'm over it. Sorry.
All right. I got something for you that later in the show. I'll say it now. How's this? This is me trying to contribute positively. I think a personality trait, and this is true probably of people on social media or more middle-aged people, is my personality is I don't like popular things, right? So they hate on anything that's popular. And my daughter was telling me she hates this because she's a Swiftie. She's a big Taylor Swift fan, and I feel like middle-aged people are saying, "Oh, Taylor Swift has another album. Oh, great, it's awful. Have you heard the lyrics?" And I'll tell you what, I was in the car with my daughter for an hour on the way to a soccer tournament this weekend. And we had to listen to the whole time because that's what we do. And I nodded my head a few times. It's not bad. I feel like if your whole thing is like things that are popular are not good, that's not a personality trait. That's just being contrarian for the sake of being contrarian. How's that? Mm-hmm. I'm saying new Taylor Swift album, not bad. That's my contribution to positive thinking for this week. How's that?
Let's get positive.
Okay. So a lot of people have wondered, why is it that the stock market hasn't cared about tariffs at all? There are no tariffs on the stock market. How's that? This is Joey Politano from Aprecitas. Has this cool Substack. He said the single largest exemption for tariffs, covering an astonishing $34 billion of imports per month, is for computers and parts, an exemption that AI companies are now completely relying on for the record-breaking investment push. So he shows the largest tariff exemptions. It's like there's Mexico, Canada, pharmaceuticals, energy, precious metals, smartphones, and computers and parts are way at the top. And he says that's a big part of the growth. So he said large parts of the U.S. economy are totally dependent on this tariff exception for computer imports. And so his point is, if free trade is delivering such amazing results for the one sector still able to enjoy it, why are we subjecting farmers, manufacturing, and families to this protectionism? In other words, if data centers get to be exempt from tariffs, shouldn't we all be? Which I think is a fair point. If we're gonna it's a good news that they decided to exempt all the AI stuff because it's helped the economy, it's helped the stock market. But maybe we should just not have them at all. How's that?
Sure.
Right?
Works for me.
Right.
Ben, I saw that Apple, I think I didn't read the story, so it was something about the Vision Pro. And then maybe scaling back their efforts to making a smaller, lighter, better version of it.
How long did you have it for? Like a week before you
week.
get rid of it?
Yeah.
I mean, that thing just bombed, right? There's like one guy who wore it to his wedding, and does anyone still use it, do you think?
Ooh, to your wedding. Tough scene. Anyway, Zuckerberg is really making a push for the glasses, not like the goggles, the glasses. And G Monster had a piece. He said they're investing $100 billion into these technologies.
God, I hope these things bomb.
So he said, I believe glasses will take about 5 years to gain traction. Once there, this technology should become central to consumer spending. And there's a picture of Zuckerberg with the glass. I don't think so. I think that society will reject this.
I hope so. I really hope so. I don't have a lot of faith in society in the short run, but the ability to just videotape someone with your glasses and not have them know it, I think is so creepy. Like, I don't think the upside outweighs the downside on these things at all.
I agree.
There's way too many creeps that are going to use these things. But here's the thing. So here, if you want to have a cynical view of AI, so OpenAI and Facebook both said they're going to roll out these AI social media video platforms. So the Sora is the new one. And I think that these companies are just better off the dumber we all get, and that's how they make money. Like, do you really trust Mark Zuckerberg to bring goodness from AI into the world? Or is he going to use it to make us watch slop videos and get mad about stuff that didn't actually happen to keep eyeballs in his social media platform? Like, I have zero faith that he's going to use AI as a positive for humanity. I think he's going to extract every last bit out of us and try to make us dumber so he can make more money.
Yeah, let's put a pin in this. There's some social media stuff later on in the show. But yes, I agree with you. All right. So Josh had the privilege of interviewing Peter Lynch last week in Boston, which was quite a treat. And one of the things so Josh did this thing where he read a lot of his greatest quotes and had him react to them. And I had forgotten how many amazing quotes were attributed to him. My favorite of all time, that's his, is selling your winners, which guilty. I've done this way too many times. Selling your winners and adding to losers is like pulling out your flowers and watering the weeds. How good is that?
I was always pretty partial to the refrigerator one too.
What's that one? Oh yeah.
Just that people do more research on buying a refrigerator than they do on the stocks that they buy.
I saw he did that bit for me in the green room. It was pretty cool to say. Playing the greatest hits.
Yeah.
Anyway, so during the conversation, Costco came up, and he was saying that he can't really make sense of the valuation. So I did some research.
Yeah, see, me and Peter Lynch, we're the same.
I did some research over the weekend, and the PE of Costco, going back to the start of the 21st century, was around 20. It's been around 20 between 2000 and 2020. And then it just exploded higher, got as high as 60 earlier in the year. And I went on Y charts, like, what's going on here? Are we getting margin expansion? Is that the deal? So the top is gross profit margin. Nope. About 10, 12%. Been that way forever. Look at operating margin, bottom line profit margin. Nope. 3%. So it's like, all right, well, let's look at the membership revenue. And yeah, this is going higher, and this pretty much flows to the bottom line. It was $2 billion in 2016. It's now up to $5 billion, but so what? I mean, it's a giant company. So I went on all of the different LLMs. I went on Anthropic and ChatGPT and Gemini, and they all said the same thing. I think it's ChatGPT. Yes, the PE multiple for Costco has expanded materially, but it's not solely or even primarily because Costco is suddenly massively more profitable. Rather, it's a combination of modest margin tailwinds, emphasis on modest, growth in e-commerce, international and scale, the strength and stability of the membership model, a premium multiple for perceived defensive qualities, investor re-rating dynamics. And they all said the same thing. There was nothing there that was like, oh, I get it. Okay, this makes sense. It just has been levitating for reasons that are, I'm sure somebody knows why. I don't know why.
Okay, that's good. So no one can answer the question either then. All right. I think it's just sometimes there's a re-rating where people just all of a sudden investors realize that. Remember, Apple had this re-rating their PE ratio.
Yeah, but 50 for Costco?
It seems a little high. Although, have you been there on a Saturday or Sunday before? Ugh, it's the worst place on earth. How about this? I'm still Open Door is up. How much is it up from the lows? Is it 1,000% or something?
It was 85 cents when he first tweeted about it, give or take.
Okay, so now it's almost $10. Okay,
Wow.
so it's a 10-bagger, more so. The Wall Street Journal had this piece on it. They said, for all the recent excitement, a crucial problem remains. The economics of home flipping business don't scale. Expecting Open-Door to figure them out now represents a triumph of hope over experience.
Oh yeah, guess what, asshole? It's up 15% today. Shove it.
I tend to, unless they completely change their line of business, if they're going to stick with house flipping as their strategy, because it says that for the first half of 2025, it had $227 million of gross profit on $2.7 billion of revenue. This is a low margin business. And to me, it's a prove it thing. If you're going to prove that technology can fix the real estate market, I got to see it first. And again, unless they totally pivot their business to doing something else, I don't see how this house flipping thing ever works at scale.
It's up 15%.
And maybe the stock doubles from here. And
holy cow.
I don't understand. Well, yeah, they've got new people coming in, but I don't see how the business itself, I don't see how it works. It's never worked to come in, right?
I don't know anything about its business. My default would be this is tricky, but I just don't know.
House flipping, housing is the one place technology has not been able to supplant. Right? It hasn't been able to work at all. I'm going to have to see it to believe it. Maybe it'll happen someday, but it has not happened yet. All right. Speaking of the housing market, it is normalizing. This is from Lance Lambert at Resi Club.
What do we mean?
All right. 21 of the nation's 50 largest metro area housing markets in September 2025 had more active housing inventory for sale than in September 2019, up from just 13 of 50 in September 2024. So in 40% of the largest metro areas, there's more houses for sale now than there were in 2019 pre-pandemic. So it's actually kind of happening a little bit. Bloomberg had this chart where they show the inventory for sale plus or minus August 2019. And it's pretty much just the Northeast and the Midwest that we've been talking about. Everywhere else is normalizing there's more houses for sale. So listen to this. There are now more completed new homes on the market than at any time in the past 16 years for sale. The problem is part of this remains kind of a buyer's strike. And I wonder if this is just rates have been so high for so long and so are prices that this normalization is gone the minute mortgage rates hits 5%.
Oh, yeah.
So to me, this seems like, yay, things are getting back to normal. But the reason they're getting back to normal is because no one wants to pay up right now for 6.5% mortgages and higher housing prices, besides you. Ex Michael Batnick. But don't you think that this is a case where, yay, we get normalization? It feels like a stalemate to me, where once rates fall, everyone back in the pool. And see you later.
Yeah, I agree with that.
Right? I don't think this is like the housing market has been fixed. And I guess the thing about it is, what was I going to say? I lost my train of thought.
That's okay. Happens.
All right. This is a cool chart. I can't remember where I found this one. Maybe someone had this on Reddit. Might have been Nick Majoli's blog. The portion of housing units built before 1960, percentage by state. You know the state with the highest percentage built before 1960 is?
Wow.
New York. 53% of houses were built before 1960 in New York. 35% for Michigan. There's going to be a lot of renovation needed in the years ahead. I think this is especially true when baby boomers start dying out of their homes. There's going to be a ton of renovations that are needed for people coming into these houses. On a nationwide, it's like 26%. DC and New York are both over 50%. Those are the two highest. It's kind of crazy, right? Michigan's 36%.
Yeah, it's a good chart. Ben, switching gears to the private markets. One of the executives at, I believe, KKR was doing an interview, and she said there are 19,000 private equity funds in the U.S. There are 14,000 McDonald's. How are there more private equity funds than McDonald's? That's actually crazy, right? That doesn't seem right.
You know, they did this for the hedge funds too back in the day.
Yeah, I
remember people used to say there's 7,000 Taco Bells and 10,000 hedge funds. Why are there more hedge funds and Taco Bells?
Can I just can I call BS? Who said there's 19,000 private equity funds? That sounds made up.
19th. No, that's honestly, that probably is because every one of these funds has fund one, fund two, like they're funds that are still in existence, right? So that actually kind of makes sense to me.
19,000?
Or you're just going on vibes here alone? You don't.
I'm sources. I made it up. I'm just saying it sounds crazy.
All right. According to Gemini, there are over 18,000 to over 39,000. There's 10,000 private equity firms as of 2020, so it's more
10,000?
now. Yeah. Private equity by the numbers.
All right,
It's a lot
so
of funds.
there's all that dry powder and you're bearish?
I'm
all
going to
right,
go McDonald's maybe.
There is a story brewing in the private markets. There's two bankruptcies in the auto space. One of them is called First Brands, I believe is the name of the company, and the other is it a Tricolor or is that a salad? I don't know. Two auto companies that went kablooey. A lot of off-balance sheet stuff, a lot of private credit things. And is this the canary in the coal mine? I will admit that I am a tourist at best here. So
With all the dry powder there is, these businesses must have been really, really bad that they would just let them fail. Because
yeah,
you think
I
they would
don't.
just take money from somewhere else to prop them up.
So Man Group had a post over the spring dispelling 5 myths about private credit. So they're saying, yeah, the market grew at a compound annual growth rate of 17% from 2016 to 2022. It's forecast to grow at 11% from 24 to 28. So it's huge. It's $3 trillion. But they have a great chart showing fixing the denominator blindness. If you look at non-investment grade compared to investment grade, you would say, what's the story here? I don't see anything. See this chart?
Okay.
As a percentage of the overall market, non-investment grade is pretty steady at, what is that, 30% or so, give or take. Anyway, there's definitely seems some cracks in the market. So some of the companies are getting hit pretty hard. The equity, Blue Owl, for example, which other ones are not doing well? KKR is hanging in there. Some of them are doing worse than others. But anyway, a lot of the BDCs are getting destroyed. So Blondes and Money tweeted, I don't own any BDCs, but the BDC squad is flashing a warning sign. All names in the toilet this year, and a lot of the sponsored BDCs like HSBD are absolutely tanking. So again, I am ignorant here. I'm a tourist at best, but I am in the camp right now that nothing bad happens. Now, I know that sounds toppy. I know that sounds complacent.
Something bad is two companies went out of business and these firms are hitting. Something bad kind of is happening.
So I bought Ares Capital Corporation, ARCC, that is definitely not investment advice again.
You're trying to catch a falling knife here.
I am. I know nothing here. I'm just, I think that nothing bad ever happens. Throw this in my face if this is the top and we have an 80% crash here. I'll apologize. But that's the mood. That's the current mood. I'm in the I don't believe it camp. And there's a lot of people that are like dying for the private credit story to fall apart. I'm taking the other side.
Are you blinded by your long-term bull thesis that the RIA money has to come in here?
Maybe.
Okay.
I don't think this is the epicenter of the next credit crisis, which I am stipulating that there it might be. I don't know how to handicap this. I have no idea.
This is another one of those things where I would love to fast forward 5 to 7 years to see how this stuff does in an actual downturn. I think it's going to be really interesting to see.
But wait, but hold on. These BDCs have been around forever. These are not new.
I'm not saying that. I'm saying the private how it impacts the private credit. So if private credit returns go from 11 to 9% because there's some defaults, is anyone really going to care about that? No.
I'll tell you who's going to care. The Financial Times. They're gonna dance on the grave and act like they called it.
All right, but if the returns went from 11% to 2%, then people can say, "Whoa!" Right?
Correct.
Then okay, game on.
Game on.
All right, sports gambling. Survey of the week. This is from Pew Research. A growing share of Americans view legal sports betting as bad for society.
Oh,
It's
you
up
think?
for 43%, up from 34% in July 2022. This is way lower than I would have thought. They say only 1 in 10 U.S. adults now say they have placed an online sports bet in the past year.
1 in
That is
10?
way lower than I would have thought.
No,
1
it's
in
interesting.
10.
These names, which DraftKings, Flutter, which is FanDuel, got destroyed last week on news that Kalshi is allowing parlays, I think.
Wait, so you can parlay like who's going to win the Oscar with
I don't know. That sounds very
who's
low
going to
to
be
me.
president of Ecuador?
Only 1 in 10. But the growing shares of Americans view legal sports betting as bad for society and sports. Yeah, you think? Listen, I love gambling. I love it. I have a lot of fun with it. It's not up to me. But if I could wave a magic wand and end it, I would.
Hey.
Sorry. What?
No. You're willing to let wealth inequality flourish, but you want to end sports gambling. I see how it is.
Well, that's capitalism. I like capitalism.
No, but here's the thing.
Well, no. Because the thing is, sports betting is it's negative sum. There's nobody
it really
winning.
is.
And don't email me if you won. I'm happy for you. On balance, it is a drain on society, and there are lots of people whose lives are getting absolutely ruined. And unfortunately, I know people whose lives are being ruined by this. And
way more people than their lives are being helped by this. And no, we had an email this morning from someone who said that his sports gambling picks beat the S&P over the last year.
Great.
He wanted to come on the podcast. It's still not legal in California or Texas. Not yet. But some politician is going to make this an issue. And if this really was an issue, that they said at the federal level, we're going to ban sports gambling. You know where there would be a big short? The sports podcasting industry. Because they are so intertwined. Everyone's advertisements of the FanDuel or DraftKings or their pick your sports book. Every sports podcast right now is
that's
powered by sports gambling.
That's first level thinking. Somebody would step in to fill the void.
Okay.
And by the way, that is weird. I'm in Texas right now. Can't place any wagers.
That's shocking to me. I didn't realize this.
I want to lose some money tonight on the Jaguars Chiefs.
It's shocking to me that it's not legal in Texas with all their whole thing about being deregulated and such.
All right. Our friend Gunjan interviewed.
Hey, credit to you for not giving us like your latest parlays of the week there that I don't want to hear about.
Nobody cares. I'm well aware. Gunjan at the Wall Street Journal interviewed Ken Rickey. He is the chairman of FlexJet. He's a billionaire, and he was very candid about how he spends money, very open, how he talks with his family about spending money. I loved it. I thought it was fascinating, and I think hopefully she does more of it because it was really good. One of the things that he said during the interview was he tips $1,000 at a restaurant when he goes there for the first time. At a hotel, when he gets to a hotel for the first time, he tips $10,000. Now, remember we spoke about this a couple of months ago? It was April, and I thought it was really cool to see a guy at the hotel take out $100 or $200, whatever it was, and tip the person. I was like, wow, that's awesome. I want to do that one day. And I could do that $100. I think I could swing that. But Robin had a good take on this. She said, wait, he's not just being generous. He wants something for that $100. And I was like, of
course.
So this guy said, and this is fair. He tips $10,000 when he gets there. And he said, if you tip at the beginning, they know what your expectations are. And I love that. He wants to get, he's doing something very, very, very nice, not to show off per se, but he wants good service. And what's wrong with that? And it's phenomenal. Now I'm a low maintenance guy. I don't need somebody like waiting on me like that. As a former waiter myself, I don't need that. But I love generosity.
If you're a billionaire, that's money well spent. Right?
Hell yeah.
I like it.
What is a better
helping out the
purpose
service industry
of money than making people's month, year? I love it.
Convenience, right?
Okay. On the other side of the billionaires, let's talk about the buy now, pay later stuff. So there was an article in Fortune with the headline, a quarter of U.S. consumers are now financing groceries with buy now, pay later, as Economic Pressures Mount survey says. I wonder if you would replace that buy now, pay later with credit cards.
Yeah, this seems like a nothing burger to me. I think young people are using these as credit cards, are they not? Is that the
Correct
story?
So from the article, more Americans are taking advantage of financing options for essential purchases. The latest sign of mounting concern. Is it really? 1/4 of shoppers have used buy now, pay later for groceries, up from 40% who used the service a year ago. Guess what? Buy now, pay later is still pretty early. What if people are just opting for that over credit cards? And I will refrain and wait till we hear from these companies on their earnings call, because last quarter we looked at this. I listened to a firm and their default rate was like
And they
nothing.
were fine, right?
Nothing.
The thing is, you could take my personal budget and say Michigan man spends and uses credit cards for 98% of his purchases, and you'd think this guy is doing awful. But no, I do it because it's convenient. It's easy. I'm getting floated a month-long loan from JP Morgan and American Express for my payments, and they give me rewards in return. It's a great deal.
All right, this is there's an article in the Financial Times talking about the decline on time spent on social media. So it peaked in 2022. They break it down by age brackets. 16 to 24, you're seeing a fairly dramatic decline. And the older you get, it's a little bit less or so. And then they show it by geography. So the global average is rolling over. North America, we're still hitting an all-time high, 2.5 hours a day almost on social media. I'm only on Twitter on nights and weekends. And I feel worse than ever about it, because during the day, thank God I don't have time for this anymore. So I'm very little time spent during the day. But I feel terrible when I'm laying with my kids and I'm on like the For You tab and I'm doing it at their baseball game. I'm only on the weekends, and I feel it's making me not happy. I don't like it.
Yeah, see, I stay away from the For You tab for sure.
How do I find it? Ben, how do I unaddict myself? Because I'm not on it during the day at all, ever. But a lot of this brain rot, is there any data anymore? Is anybody saying social media is like a net benefit, or is that charade over?
This is a good thing that it's falling. I still find value in it in terms of finding charts and stories and stuff that we use, but I'd be lying to myself if I said that's the only reason I'm doing it, obviously.
No, you're addicted. So am I. But guess what? You know what? If you just looked at the daily chart book every day and what some of the other Substacks and Sam, you'd be well taken care of. You don't need to be on social media.
This is true. Yeah, no, I've been doing it for way too long. I can't help it. Okay, this is interesting. This one got Galloway. We talked about the slop stuff earlier, and he said people don't actually want to create content. They just want people to feed it for them. And that's where like OpenAI and Facebook is going to step in and do it. So he says 4% of YouTube videos account for 94% of the views on the platform. 5% of videos on TikTok generate 89% of the views. And Instagram is saying 3% generate 84%. The top 25 podcasts reach nearly half of US weekly listeners.
You know what's interesting? But I'm on Instagram too. And Instagram doesn't make me feel bad. I get enjoyment out of it. I don't feel like the world is ending after I close my Instagram app.
Yeah, see, it's kind of funny. I don't really use Instagram, but because it's harder to make the world look bad through pictures, because that's in a lot of cases reality, unless it's AI crap.
Is the simple reason? I haven't thought about this, but I'm sure a lot of other people have, because there's just no sharing, there's no retweeting, there's no quote tweeting,
and dunking on people.
Yeah, negativity doesn't go viral. It's just good vibes.
I don't know. But anytime a tweet now gets more than a certain amount of likes, call it 500 likes, I can't believe how many trolls there are coming out of the woodwork to tell you how awful things are and how terrible
I can't believe you can't believe it.
It obviously, that's the thing that's gotten way, way worse in the last 5 years, is just the sheer amount of people who think everything is bad at all times, or that's the character they're playing. I don't know. All right. So, story time. I said my daughters are Swifties, so my wife took them to see on Sunday morning to see, apparently there's some Taylor Swift music video thing that's tied to a new album in the movie theater. I think it was the #1 movie this weekend by box office. My two daughters and my wife went to see it. So my son, what do you want to do? Me and you go do something. And so we went to the zoo, and it was a good reminder about graduating from certain levels in your kid's life that I never even thought of that much. When our daughter was younger, our first daughter was born, we got a pass to the zoo. And we would go to the zoo almost unless we didn't have plans, we'd go there every weekend because it was something to do. And when your kids are really young and they're still in like stroller age, right? Let's go to the zoo. She likes it. And we'd go there all the time. We use that family pass so much. And I went to the zoo and my son and I were walking around and realizing we went there on Sunday morning, like 10:30 in the morning, before the crowds got there and before it was too hot. And I'd say 95% of the people there were parents with kids in a stroller. And, oh, look at the Anna, and it's just, I forgot that, oh my gosh, we totally graduated from that thing. And I never even realized it. And now we're on to the weekends are full of sports games and such. And I had a physical last week and my doctor was asking, if you go to a doctor or a dentist, they always ask you, hey, how are the kids doing, right? Every time. And I don't know if they really care. They just want to ask you. But my doctor said, what's going on with the kids these days? And I said, well, by the way, you coming back? Should I keep going?
No, go ahead. I'm right here. My computer's dying, so I'm just...
Okay. So I tell him, we're in it with youth athletics. And we have soccer, we have football, and every day, Monday through Thursday, every day we have a practice. And then on the weekends, we have 3 or 4 games every weekend. And he said, God, I'm so glad to be done with that. And I think the opposite. I absolutely love it. It's fun. I don't know what else we'd be doing with our time. Obviously, I'd maybe be relaxing more or something, but I think it's so much fun to graduate from that old stroller mentality of you're trying to kill time because you don't know what else to do until nap time to now you actually have stuff the kids are involved in and liking. And anyway, it's just, it was the first time I realized in my life, like, oh my gosh, we graduated this. And then I guess the next step is when they become like social creatures in high school and they leave you alone and never want to do anything with you.
Yeah, I see both sides. I hear what you're saying. I think you're probably right. I'm wrong here, but I was so freaking bored at Logan's T-ball game the other day. And I actually felt like shit because I was the only asshole. Robin was home. I was by myself and I'm on Twitter on the For You tab. And I look up and I'm like, why am I torturing myself? Nobody else is on their phone. Nobody else.
That's true. They're too into the game.
But I also do one.
Put it on your Audible books.
So I'm reading our friend's book. Morgan wrote a new book, The Art of Spending Money.
Yeah. I got it behind me somewhere too. Yeah.
And Morgan's going to come on our show and talk about it. And there was one part about like talking about like what matters. And obviously, time spent with our family and stuff. And Morgan wrote something about like, how much freaking time are we wasting on social media? I know it's lame to complain about, so whatever, forgive me, but this is my podcast. So.
Well, you were really harping on this week, huh?
Yeah, I am.
I come to Jesus moment.
I think I'm just like peak. I just got to get off this thing. It's just poison. I don't know what else to say. It's just, you know what? It's a young man's game, young person's game, the social media thing.
It is, but we've all aged with it in a lot of ways.
Yeah, but I think I think we've aged out of it. That's what I'm trying to say. What else was I going to say, Ben?
Because you say you're not feeling the sports stuff. Listen, no offense to baseball people. Baseball as a parent, baseball is really, really slow.
It's really tough.
When my son retired from baseball, I did not think twice about asking him again if he wanted. Are you sure? Are you sure? No.
Now, even though I'm bored, I am never I can't wait for X person because I'm very cognizant that, we're going to die. People die early.
Oh, yes. So right. I can't wait till this stage.
Yeah, I definitely, I never go there. I don't think about that.
I'm the same way. The thing is, here's the thing though. My daughter had a game in Lansing, which was like an hour away, soccer game this weekend. And it was my turn to bring her because my wife had to go to my other daughter's soccer game. So I was in the car with her for an hour, no screens. We listened to the new Taylor Swift album, but I just got to talk to her for 2 hours straight. And that's the best part, the before and after the games. And I try to have a rule too of unless it's positive, there's no constructive criticism or anything for like 24, 48 hours. And usually at that point you forget about it anyway. So there's no like, hey, next time in the game you should try this. Like my wife and I talked about it, like none of that. We're not doing that. We're not being those people. Because everyone hates that person who like tries to get in and coach their own kid,
Yeah. Speaking of aging out of things. So I think we're going to go to Disney in December. This is probably going to be our last year.
All right, I'm going in November. I'm going in November, so I will give you all the tips.
But I feel like Kobe's 8. No, we've been to Disney, but like there's like a very like the boys become like too cool for things pretty around what, like 10? I don't know what the age is.
I could see that. My wife and my kids really want to go to Disney again. I got to be honest. This is one of those things that I would like to be graduated out of. You said I don't want to look forward.
I love
Disney. Is just, you do.
I do. I love it.
Okay. Just not my thing. I hate crowds. I hate waiting in lines. And we're going to probably do the thing where we get the passes and stuff. My wife's going to have that all figured out. It's too much for me.
Okay.
It's too much.
Yeah, I get. No, it's not for
everyone.
But
we're going over Thanksgiving weekend.
All right. So
recommendations.
I have one thing. I've been. This has been a busy part of my life. Been traveling a lot, moved houses, Jewish holidays, unpacking, all that sort of stuff. So I haven't watched Black Rabbit or Task in a few weeks. I just been going to sleep every night. I get into bed. But I did start to watch one new movie, Ben, because I don't know if you know this, but it's October. You know what that means?
Oh, even more horror movies for you?
So for my fellow sickos, there is a new VHS out on Shudder. I only watched the first segment. Ben, you don't have to worry about this. And yeah,
wait,
it's
why
sick.
is it a VHS?
No, that's the name of the movie. There's like 5 or 6 of them. It's called VHS, and there's like it's like home video / found footage, and just completely demented. And VHS Halloween, the most recent one, is no exception. I saw the first segment. Like I said, it's probably, I don't know, 15-minute bit. And I had to turn off. I said, this is just too much. In the best way possible. Just totally demented. Totally sick stuff.
Okay. I finally watched F1 this weekend. And I know I should have seen it in theater. It was a very fun movie. It was very stylish. It almost in some ways felt like I've never gotten into F1. I know people who watch the Netflix show, like Duncan loves F1. I know people get up early to watch it, and people became big fans. I've never been like a racing person, so I never got into it. So I felt like it did a really good job of bringing me along as someone who knows nothing about F1.
Yeah.
It did a great job of explaining it. I knew nothing about it. I recognized some of the names, I guess. It did feel a little bit like a commercial for the sport, but I guess that's probably what they're going for. And the stakes of the movie never felt that high. It was just a very entertaining movie, like a very easy watch.
Good, clean.
You weren't on the edge of your seat. I'm sure being at the theater in the racing parts would have been better, but honestly, on my couch, it was fine. I liked it.
In Boston last weekend, there's an F1 bar in the Seaport, and we did some fake racing. By the way, gotta say, Boston, great city. Oh, quick story.
So you did the Boston to Austin now, since you're in Austin this week.
Boston to Austin. So a friend of ours, I went to go meet him for breakfast, and he gave me his address. I punched it up. Oh, this is great. I've never been to Cambridge. I'm going to go see Harvard and see what's up. So I took a blue bike there, which is their version of the city bike. It was a 7-mile ride. So it probably took me like 40 minutes. It was great. It was lovely. Beautiful weather. I had a great time listening to Team of Rivals. And it was just a really, really enjoyable moment. So I call him. I'm like, hey, I'm here. I come get you. He calls me. Hey, where are you? I'm like, I'm outside. He goes, where? I said, I'm next to the whatever bar. He goes, you in Cambridge? I said, yeah. He goes, dude, I told you I'm in whatever town. And I'm like, oh. So there's 6 Church Streets in Boston. I went to the wrong one.
So he should have given you the name of the restaurant or the bar, not the address.
He gave me the address in the town. I didn't punch in the town. That's hand up.
Okay. All right. I got one more thing on F1. You and I talked about when we saw Gavin Rossdale. He's 60 years old and man, still a great looking guy. Brad Pitt. He's like 61, isn't he? 62? He's still got the fastball, man. All right. I did finish Black Rabbit, and I don't know how far you are into it.
I'm only on episode 4.
It's one of those. Okay. It's one of those shows that makes you very uncomfortable because bad things keep happening. And you're like, now this is going to happen. Oh, now that's going to happen. Now this, like, that's my
type of show.
Okay. It's just things constantly going wrong and nothing ever going right. And to me, I get very uncomfortable with that. But then you want to know, how is it going to end? How are they going to wiggle their way out of this? And I thought like the ending it was fine. It was a good show. Good, not great. Like a 7, not an 8, I'd say. I enjoyed it. And my wife and I, we binged it pretty quick because we wanted to know what's going to happen. Finally, you mentioned I'm not going to sports games and doing the For You tab like you, sicko. I bring my son an hour early for his football games so we can warm up. And by the way, we're listening to Rage Against the Machine on the way to his football games, get him pumped up, which is pretty great. He's like, hey, put that stuff on again. I liked it. So I put some earphones in and I put my Audible on and I walk around, the school campus. And so I've been listening to the Hamilton one. I'm almost done with it finally, which is really, really long. Probably way too long. Listen, Ron Chernow, great author.
Way too long.
Just cut 40% of it out.
Yeah.
But the stuff that people write in all biographies when they describe a person from the olden times, it all sounds the same.
He was a barrel-chested man.
Yes. He had a bulbous nose and rosy cheeks, a pointed chin, and you kind of go, who cares? I don't care what he looks. They're all kind of, anyway, that's what you get in biography.
All right, Ben.
Anyway, great stuff in that book.
It's not our fault, but can we try and make a pact to do an AI-free episode next week? Now, listen, we didn't make the deal with OpenAI and AMD. Like, I'd love to talk about something else.
We're in the midst of a mania. Why do you want to talk about anything else?
I feel like it's a lot. I feel like the audience is bored. Frankly, I'm a little bored.
You said this is potentially one of the biggest stories of this century, and you want to just sweep it under the rug and...
No, I don't want to sweep anything under the rug. Can we maybe take a week off? Maybe?
All right, if we won't debate whether it's a bubble or not. How's that?
Yeah.
Okay.
Listen.
All right, that's fair.
Last thing. Let's choose a little bit of positivity. I want people to finish our episode feeling like this is the not for you tab. I want people to feel good. I know there's a lot of really ugly shit happening in the world. There always has been. Unfortunately, there always will be. The world is a dark and scary and dangerous place. But I feel like people don't come to us for that. And I just want to put out goodness. That's all.
I put the good news of the week heading in here. I want you to fill it up for next week. How's that? That's your homework.
I mean,
all right, hey, these hats at idon'tshop.com, I believe they're sold out at the moment. The compound hats.
They are.
They're going to be coming back soon. Right?
For those of you who are listening, Ben just put his hat on.
They're coming back soon. And these are the trucker hats with the compound. People love them. They're coming back soon. Hopefully Nicole will let us know and we'll let you know when they're back. But they're sold out right now because people love them. idon'tshop.com for all your merchandise needs. I was passing out the Animal Spirits koozies to my friends, the dads at the soccer game the other day. That went over well.
It's great stuff.
Those are fun. All right. Send us your email, animalspirits@thecompoundnews.com. Thanks to the production team, as always. Michael's been filming in different cities every week, it seems like. And they're dealing with his spotty internet and everything else. So thanks, everyone, for listening, and we'll see you next time.